Ange, thanks for joining me on the podcast.
It's a pleasure. Great to be on.
Here in Sydney. Is this your first podcast you've done?
Could be, yeah. I think yeah, you're right. It is my first official podcast, actually.
Because you do some of your own videos and things like that, which are great.
Yeah, just keep the candid content, keep that casual. But if you want to get really technical, yeah, this is definitely my first podcast.
Okay, great. Well, thanks for coming on. Today we're going to be talking about loans for business owners, for sole traders, tradies. We're going to be talking about all different types of loans, not just standard like residential loans. So for anyone that's in the market has heard like trusts and things like this on social media and what people do with those to buy property, this is the episode for you. A little bit about you though, mate. You're a business owner. You run your own business now. How did you end up becoming a broker?
Ooh, look, I didn't always plan on becoming a broker. To be honest, being born overseas, moving over to Australia, having parents that just work 2 jobs, I didn't really know what to do. Like I've always been into my sport, and in high school I wanted to be a physio.
Oh, right.
Ended up getting a better ATAR than what I expected, and I studied Bachelor of Business, major in finance and accounting at uni. Mm-hmm. And then long story short, again, still sort of young, like you're 17, 18 at uni, you don't really know what you want to do. I didn't have the guidance from above as well to sort of guide me anyway. One of my best mates at uni goes, I just got an internship. I go, what the hell is an internship? He goes, before you finalise your uni degree, the year before too, penultimate year, you go work for an employer over your summer break. If they like you, they can offer you a graduate role.
Yep.
And that's essentially that night I went and applied for an internship at KPMG, had the internship there and landed the grad role. So as soon as I finished uni, straight into KPMG, started off as an accountant, spent about four years there, did my chartered accountant as well, membership.
Which is not easy for people that are watching or listening. It's not easy to get your CA.
Oh no, it was brutal. It was long hours, full-time work.
I've heard the hours at one of these big 4 accounting firms are hectic.
Yeah, it's all project based. It's all project based, and it can be hectic. Like I remember there was months on end where we were clocking over 60, 70, 80 hour weeks. And then on top of that, you do have to find the time to also study for your CA.
So 80-hour weeks plus study.
Yeah, so it was a lot of weekend work as well, more so for the study component. But throughout the week, it's pretty hectic and chaos. Like I couldn't physically or mentally fit in any study for that throughout the week. But that's just because of the projects. Like I was on a fair few big projects. There was a lot of year-end reporting, assurance work that we had to do. So it was a bit chaotic. Once that project is done, it's fairly good as well. Good environment, but it's tough. It's tough, especially coming from someone where I was the first, or a family where I was the first sort of individual to work in a corporate gig. It was challenging, and my mum, being caring, I'm sure, like every other mother, coming home at 12, 1 a.m. sometimes, consistently month on month, she was worried. She was like, what's happening? Like, are you literally working from 8 a.m. till 12 a.m.? I'm like, yeah, there's that much work to do. And, I sort of saw it both ways. I can, whinge, have a cry, or, I can build resilience from this experience. I put my head down, come out of it stronger, learn about myself a lot. And that's where like the character piece really came into it. So lasted about 4 years there before I decided, that I want something that's a bit more client relationship, client focused. And luckily enough, COVID was a bit of a horrible period for everyone. But for me, an opportunity arose where I had the opportunity to go to CBA on a secondment as a credit analyst to assist with the government guarantee scheme loans for business owners. During that secondment, I was ranked one of the highest analysts there. And long story short, went back to KPMG, and then an opening came up. I decided to apply for it, and they knew me from that short 3 months secondment, offered me the full-time role, and that's how my lending career started.
Just going back to your KPMG days, I'm reminded of the quote from the Goldman Sachs CEO who said, if you don't want to come in on Saturdays, don't bother showing up on Sunday, which is a great one. So yeah, working your guts out. Then you go to CBA, and then you're there for a while, and now you've got your own business. Well, there's a step in between that, but like take us from that to now.
Yeah, so at CBA, started off as a business banker and just made my way up through the corporate ladder to being a relationship executive just before I left, which essentially is a lending role where you're specializing in both commercial and residential lending. You also manage a clientele or portfolio of clients. And, that's across maintenance, new lending, pretty much everything. But you also work with other teams. So teams that purely focus on transaction banking, asset finance, all that sort of stuff. And then from there, it was challenging. It was rewarding. I really enjoyed it. I enjoyed the relationship aspect. Also always sort of being involved in sport and being around people. Like I really just, a lot of transferable skills, right? From there, as a banker, so call it, you work with a lot of brokers. And a lot of them kept saying to me, we really love how proactive you are, organized. We really love working with you. Because with, I guess, commercial and residential lending is completely different. With residential lending, I guess the broker's always in control, but it's them submitting an application, goes through the portal, it's picked up by a credit analyst.
At the bank.
With commercial lending, you're always dealing with a banker or a commercial banker, depending on which lender you go to.
So if I wanted to get a loan for my office building or something like that, or for a warehouse or something,
that's right.
If I'm a plumber.
Yeah, that's right. So you and I would sit together. We'd have the broker-client relationship.
Yeah.
We'd put together, like I'd run the numbers, we'd put together a proposal, essentially paint a picture. Then depending on the lender we approach, let's just say it's NAB. Someone from NAB a banker from NAB would actually pick up that proposal and workshop it with us as well. If they need anything further, they'll come back to me, being the broker, and then they will submit that proposal to credit.
Right. Okay.
So my submission doesn't go straight to credit.
Yeah.
That's where my relationship with different commercial bankers as well across different lenders is important.
Yeah. Okay. So it's quite different to then getting like a residential one, which is like, what's your income, what's your deposit, what property you're buying, very kind of cookie cutter.
Yeah, of course. I mean, it all comes down to coded versus non-coded, right? So with your residential loans, predominantly a lot of them are in individual names, which are governed by the NCC, National Credit Code, and it's regulated, highly regulated. With non-coded or commercial loans, you're generally borrowing under a SPV, special purpose vehicle, whether it's a company, trust, whatever your accountant advises on. So with that, there's just more flexibility. You can forecast income, projections, use sort of annualized data or BAS statements, things like that, which it's a grey field, put it that way. If it makes commercial sense and there's enough backing and comfort in the sponsors or the guarantors, which are normally the directors or shareholders of that entity, and we can prove to the bank or give them comfort why they should accept this deal, then we can make it work.
So if this would be relevant for anyone that's like I said before, a business owner, maybe even people that have like an SMSF are trying to buy property, commercial property, anyone that's like a lot of tradies, I imagine would be if they run their own business, they would get to a stage where they're like, well, can I buy a warehouse? Can I buy equipment? Can I buy whatever?
Yeah, of course.
And it becomes more about relationships and less about the filling in the form and just sending it off.
Yeah, of course. Yeah. Of course.
So why did you go out on your own? You got the Solara Financial t-shirt on. Why'd you do that?
Honestly, it was all about education. And a lot of being at the bank, there was a lot of credible clients that we just couldn't assist. Not because they had bad credit or anything like that, but just certain policy and metrics. For example, with majority of the major banks, they want to see a minimum ABN of 18 months, right? If you've had a ABN of 12 months and you've had an absolute tremendous year, it might be a no from the major bank. Things like that where you couldn't assist.
But it was obvious to you.
It was obvious to me that there's potential here. like if we support them during their growth and early stages, then, you might have a loyal client that will stick with you for life.
Yeah.
But because we're not supporting them within that first, 0 to 12, 15 months time, it'll leave a sour taste in their mouth, right? And they might not come back to you in the future. Things like that, alongside actually educating these business owners around their finance while you're assisting them with their finance needs, just prompted me to sort of go out on my own and start Solara Financial.
Well,
so
because you got an accounting background, it makes a lot of sense as well.
Yeah, of course. I've been on both sides of the fence. Being an accountant, being a lender at CBA, I understand how to look at a set of financial statements, tax returns, and then I also understand the credit acumen as to what your credit risk officer needs to see or wants to see.
Yeah. Why did you call it Solara?
You know what? I was just sitting there thinking of all these different names, and then I was like, whoa, what am I about? I'm all about positivity, good energy, and just bringing that all together. And that's what essentially Solara means in Latin.
Oh, right.
Yeah, it just means good energy, good vibe, positivity. Brought that together, and it's sort of a reflection of what I want to instill on our clients' journey. Yes, it's one of their biggest decisions of their life, taking out finance, buying a property, buying a home, taking out a business loan, whatever it may be. But along that journey, we want to make sure that it's not stressful, we're in control, and they see the positive aspect, and they're enjoying the journey.
That's cool. I always like to hear how businesses get their names and the logos too. It's always cool.
Well, if you have a look at it closely, you'll see the top of it is an S.
Yeah.
And then this is an F at the bottom.
Yeah.
But it's also a key for a house.
Oh, wow. We're going to have to, for anyone that's not watching, yeah, it's cool. It's like an S-shaped house. Yeah, cool. Yeah, okay, I like it. That's great. Just quickly, I want to ask you one business-related question. What did you do to prepare to launch your own business? Like just at a high level, and what would you suggest for anyone that's listening to this that does want to start their own business? What tips would you have?
Well, for me in the mortgage broking world, it's difficult, right? I couldn't just take it on as a side hustle, which in a lot of industries you can, because there's a big conflict of interest there. So you can only prepare so much. And at the end of the day, you also have to have faith in yourself. But I essentially put buffers in place, safety nets. I had some savings. I also had property. I cashed out equity against property and structured it as interest only. So only if I really needed to utilize those funds, I would have to make repayments on there.
Yeah.
Otherwise, it would just sit there as a safety buffer. Essentially controlled as much as I can before I left. And then honestly just had faith in my own abilities that you're going to provide a good service, and slowly it will come.
Cool.
It's tough to say, like you don't have a crystal ball, right? But if you are planning to essentially jump the gun and go out on your own, you're always going to be learning as a business owner, whether it's year one or month one or even 10 years down the track. You're always going to learn just how to refine your skills and build efficiencies in your business.
Definitely.
But I think definitely have set goals and refine those goals or revisit those goals every couple of months.
Cool. Like it. So before, I've got these questions for lending if you're a business owner. So these are questions that I'm going to prompt you, like the questions that you would maybe ask your broker before you get a loan. But I wanted to ask you, for people that aren't familiar, they might not know that if you have pay slips, it seems to be so much easier to get a loan than if you're, so if you're a PAYG versus if you're buying a property or you want to get a loan for a business or whatever the case may be, just a loan in general, and you're not a PAYG. Why is it so much different, just generally?
Consistent income.
Right.
So you got to look at it from the lender's eyes, right? They want to have as much comfort around your position as possible. With a PAYG individual or someone that's earning a salary, to simplify things, they know every fortnight or month that payment is going to come through, particularly if they're a full-time employee.
Yeah.
With a self-employed business owner, that income can be inconsistent. There's no guarantee. Some businesses are seasonal, some are not. So it's all about comfort in their eyes and what gives them the least amount of risk. Saying that though, with business, it's uncapped. So the sky's the limit with how much you can earn. With PAYG, it's consistent income. So that's why, generally speaking, it's a lot easier to get PAYG loans across the line. There's only so much, I guess, things or questions that credit can ask with regard to your income because it's so consistent.
Yeah, that's one thing that it's always been impressed upon me, and I don't think people realize this, is that it's all about income. It's all about how much you can, prove that you can repay. We're just talking off air about first home buyer schemes and stuff, but it's still dependent on your income.
On your income, correct.
Yeah, it doesn't matter what the scheme is. It's your borrowing power that really matters.
Yeah, of course. Look, there is strategies that get a bit more technical around trust borrowings and things like that, but deep down, the underlying factor is still going to be income.
Yeah, cool. So the first question is, this is one that business owners can ask their broker, is how will you assess my business income, and will you take BAS or accountant letters if my tax return doesn't show the full picture? Because I imagine there's a lot of people that listen to this that maybe they're in that startup phase, or maybe they just, they're saying, no, I'm earning more. Like we probably have a lot of tradies listening. What would you say to this?
It honestly just depends at what point in time they are during the phase that they want to borrow. Right. So, and the beauty about self-employed lending these days is there's multiple pathways. So to give you a quick summary, your major banks, they have simplified self-employed policies where we can rely on 1 year financials or tax returns if that's all up to date and prepared. Simple accountant's letters to support existing income, etc. Then if your accountant financials are not prepared, you can go down the ranks, so your second and third tier, and things like that where they won't request tax returns or financial statements because they might not be ready, or we're in FY26 now, your FY25s might not be ready. So alternate documents that we can use are BAS statements, are business bank statements, are accountant's letters. So I guess what you're going to cop is potentially a slightly higher interest rate, but at the end of the day, it all depends on how important this loan is for you. If you want to get into the market now, like you can't wait 12 months time, let's say, until your financials are prepared, or 6 months time, then it might be a strategy of, hey, let's get you in the market through a second or third tier lender with an accountant's letter or BAS statements. In 12 to 18 months time, when your financials and tax returns are up to date, we'll refinance you out from there into a major bank because you are a credible client.
What would be an example of a tier 2 lender? So everyone knows the big 4 banks, ANZ, Westpac, NAB and CBA. And then you could say big 5 if you included Macquarie. But what would be the example of a tier 2?
Lenders like Bankwest, Suncorp.
Those ones.
Those were ING, things like that. And then they're still, their policy is still sort of in line with your major banks. They might have a few niches and things like that. But once you get to like the third tier, that's when those ones will start accepting accountant's letters as purely the income verification doc and things like that.
The next question is, how will you calculate my serviceability of the loan when my income is inconsistent and fluctuates month on month? Why is this important to ask?
It's important to ask because, well, one, it sort of just depends on whether you're looking for a home loan or a business loan. And why I ask that is there's a variety of different pathways we can approach. So I'll give you an example on, we'll stick to the commercial loan or business loan. So certain lenders will allow you to provide one BAS statement. They'll look at that last quarter and they'll annualize it across the year. That is purely the only income document they will need to verify your income. The rest is a self-declared financial position where you summarize your assets and liabilities. Mm-hmm. And that is for any lending up to $2 million.
Right.
Supposedly that it is for a secured asset. So you're going to buy some sort of commercial asset. So a lot of instances is you've got a tradie, let's say, they've had an absolute cracking last quarter. We can use that document, annualize it. They want to buy a commercial warehouse, so we'll need a 20% or 30% deposit and then it's a declaration of their financial position, assets, liabilities.
So just running through this one more time in my own head. So I have, say I'm a tradie and I have a really good quarter. I do $250,000 of BAS, which for people that are unfamiliar is the business activity statement. It's like what you report to the ATO. So say 250,000, you would effectively multiply that by 4.
Correct. Yep.
Because it's annualized then. And that's what then you can present to the bank along with the other documents around assets and liabilities.
Yeah, that's right. So they generally have a business activity statement calculator. You input, your total sales, wages, etc., etc. You'll have a surplus figure. But generally, yes, that is the only income document we'll need. We'll present that to the bank, self-declare our assets and liabilities, and servicing can be done that way.
Wow.
So that's like a streamlined pathway with a major bank. And the beauty about it is there's no actual penalty to your interest rate. That's just one pathway they've introduced recently.
Because that'd be good news for basically every tradie or contractor that listens to this that has previously thought, well, I need 2 years of financials, I need 2 years tax returns, I need all this stuff.
Yeah, of course. So again, you still need the 2 years of your ABN to be registered.
Yep.
But with regard to the actual servicing, definitely don't need to provide 2 years. Again, your credit needs to be sort of in par with what a major bank would accept.
Yep.
So that definitely has to be clear. But yeah, it's like I said, the pathways available for business owners, particularly in the business lending space, but also the residential space is really good.
Next question is, do I qualify for a low doc home loan as a small business owner, and what's the cost difference? Maybe just define what a low doc loan is, and then, what's the cost difference?
So low doc loans are what we touched on before. Essentially, when we don't have accountant prepared financials or tax returns that we can present to the bank, we will revert to something called a low doc.
Yep.
And certain low doc income verification documents we can present are your BAS statements, accountant's letter, and business bank statements. So these are just alternate documents that lenders are comfortable with accepting if you don't have your tax returns and financials ready.
Okay. And do you pay more in the interest like you were saying before?
Yeah. So again, it all sort of depends on your credit score as well. So once we sort of head down the bracket to these third tier lenders, which generally accept these sorts of pathways, they normally categorize you in different loan or products they offer. If your credit is really clean, you're the perfect client, you just don't have your tax returns ready, you're going to be technically labeled as a prime customer to them. So your interest rate will slightly be higher than what you sort of will receive your second or first tier banks.
Okay.
If your credit is severely impacted, you got adverse history, you've got arrears, and you still want to go down the accountant's letter pathway, you're going to probably be paying 2-3% higher on top of
5%, you get 8% or 9%.
8-9%. And then on top of that, you still have to service the debt with their buffers in place.
Right. So then that add extra buffer for their
own sort of
that's for their own risk.
For their own risk.
So they're assessing you on more than 10% interest rates.
Correct.
Yeah. Wow.
Yeah.
Okay.
So again, it all sort of comes back to your goals and needs, right? What's the main purpose behind the lend? Yes, you want a loan for a house or an investment, but how quick do you want to act? And then you just strategize with your broker.
Okay.
Do we get you in the market now and refinance you out once your credit is repaired, or can you not afford repayments at 9% interest rate? So is it worthwhile holding off for 6 to 12 months?
Okay. Cool. It's really interesting for folks that again didn't think that was an option for them. You did a video actually recently. Maybe I can ask you this at the end. No, I'll do it now. You did a video recently on your LinkedIn that talked about like using trusts for buying properties, and in particular, it was talking about commercial properties. And there's a potential that some of the rents may be able to be taken into account for when they calculate the servicing and the repayment ability and blah 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 blah. Can you just talk high level about that and just trusts in general?
Was that the commercial lease stock?
That
you spotted?
Yeah.
Yeah. So the commercial lease stock is a really cool, I guess, pathway that's been introduced. And it's more so for commercial investment. rather than owner-occupied acquisitions.
So if I wanted to buy a warehouse and then have it leased out.
Yeah, correct. So the biggest driver behind that is the lease. That's the biggest value with this transaction. And what it is generally speaking, the banks will lend you a 70% loan against the market value of the commercial asset.
Mm-hmm.
So you have to come up with the 30% plus stamp duty.
Mm-hmm.
And the main metric that they use to assess your serviceability is what they call the interest cover ratio, which is the net income of that property. So that's why the lease is such an important factor.
Yep.
Over the interest only expense of that loan.
Okay. So just the interest.
Yep. Because that's how you would structure the facility anyway.
So they're taking the income that comes from renting it out.
Yep.
On a net basis, so after costs or whatever, compare that to the interest only.
Expense. Yeah, that's
and are
right.
they looking for a particular ratio there, or?
Yeah, they generally look at 1.5. However, there are lenders that will, go down to 1.2 even.
Yeah, right.
You might pay a bit more of a premium again on the interest rate, but there's definitely lenders that look at that. And again, the way you structure this facility is on interest only. So let's just say the lease term is 4. Generally speaking, your interest only loan will be about 75% of that weighted average lease term. So you're looking at like a 3-year term, for example.
Huh.
And at the end of that 3 years, generally speaking, the lender will reach out about 6 months prior to expiry, go, hey, what's going on here? Has the tenant renewed their lease? If so, do you want to roll over your facility?
Yep.
Or do you want to pay it out completely? Like, what are your plans?
Yep.
But it's not just like, tell us now, otherwise we're going to close the facility. It's you're dealing with a commercial banker on the other end.
Yep.
That will, work, that you'll work.
They probably want you to roll it forward if all things equal. They probably want to keep making money from you.
Yeah, for sure. I mean, they hold the mortgage anyway, so it's just like the rolling over process is simple.
Yeah, cool. Next question is, what deposit size is realistic for me to avoid LMI given my business structure? Now, I did have a note in here that, and it relates to something you said earlier about working with business owners earlier on. CBA would hate me for saying this, but I originally created a CBA bank account for our business. But I was so annoyed that they charged $10 monthly account fee on every account that you opened. I was just so pissed off about that. I was like, just based on principle. So I marched down to the bank and I said, can you just waiver these fees? Like, NAB doesn't charge these fees.
Yep.
And they were like, no. And then I was like, oh. And I thought I was stuck with them. So I was like, okay, I guess. And then I was like, okay, I just need to set up a trust bank account, like a corporate trustee bank account. And they were like, oh, you have to book in for that. And I was like, oh, well, when? And they're like, oh, our people are only here during the week. I'm like, well, I kind of need to speak to someone because I work during the week. And then I just walked straight out of the CBA branch and directly opposite, this is in Camberwell in Victoria, I think it was Camberwell, directly opposite, there was a NAB branch. I walked in, I said, do you charge monthly account fees? Like, nah. I'm like, can you do this? And like, yeah, come sit down. Literally, now they've had my banking forever. They've got business loan as well as home loan with them, and would probably just stay with them because of that whole relationship from the get-go.
Yeah.
So that's the difference.
They're a really enjoyable bank to work with. NAB.
Yeah.
And
so my question to you is then, what deposit size is realistic? I'm assuming for a business owner to avoid LMI given a business structure.
Well, let's break it down with LMI first, lender's mortgage insurance. Essentially speaking, it's an insurance premium the banks take out when you generally exceed more than 80% LVR of the loan.
Yeah.
And it's actually the client that bears the cost. So the bank takes it out to protect themselves, but it's passed on to the client.
Yeah.
Now, for residential loans, anything above 80% loan to value ratio, LMIing is involved.
Yeah.
So yeah, to answer that, you'll need a 20% deposit to avoid it.
Yeah.
However, with business loans, it's a bit different. So lenders like NAB do have certain policies where if you do have your residential loan at 80% LVR and you wanted to take out a business loan for commercial purpose, they can actually rely on your residential equity security and the equity involved there and essentially overextend to 100%. And there's no LMI on top of that.
Because they're saying, well, we've got your home as security anyway. We know what that's worth. We've done a valuation. We'll give you the extra 20%. Normally we wouldn't do this, but you can have it with no LMI because you're a customer and the property is security.
Yeah, that's right. So every lender has different sort of metrics as to what they classify as a fully secured loan. So let's just say NABs is 80%. This is more commercial. That 20% loan that you take out for commercial use is technically going to be deemed partially secured until your asset that secures the loan rises in capital.
Yep.
Until it's again fully secured according to their eyes. So during that period, you are going to pay a higher interest rate. You're not going to get an interest rate as if the loan was fully secured. But again, if you can make it work from your income coming in through the business, and you might need it, it's definitely worthwhile.
Yeah, cool. So I guess, what about if there's a sole trader? It probably doesn't. Say, for example, Ange, if someone was like, they've been a sole trader for years, and they're running the business, and they're decent, like it's profitable, and they're pulling a wage. That's the most important thing. So they're a few years in. Is there any difference there around like avoiding LMI for them because they're a business owner, or is it still the 80% for residential? Is it like based on what you're buying?
Yeah, with residential, there's no way around it. It's definitely 80%.
Right.
If there was any business component that they were interested in, the same principle would apply. Okay. They'd be able to overextend.
I've spoken to other brokers on the show before, and they'll say things like, well, yeah, 20% and then you'll pay LMI. 80% then you'll pay LMI. But some LMI is okay.
Yep.
Like, it just depends on what your means are and what you want to buy.
Yeah, 100%.
Would you agree with that? Or
I agree. So again, it just depends on...
Because a lot of people hear 20% deposit and they're really put off. And obviously the government's brought out schemes for first home buyers recently and that type of thing. But I guess what was always impressed upon me was that it doesn't really matter that much about LMI as long as you're getting the property that you want and you're going to stay there for a while. It should work out in the wash.
Yeah, 100%. So there are certain niches and things that lenders allow where there's LMI waivers for certain professionals, lawyers, medicos, et cetera, but let's just exclude that for now. Talking purely LMI. The beauty about it is, generally speaking, there's a sweet spot that I like to say. It's 88%.
88.
So you'll essentially contribute about 12%. We'll take out an 88% LVR loan against the property and actually absorb the lender's mortgage insurance onto the loan, which will take our total capitalized LVR to just under 90%.
Right.
And the reason why I like to structure loans that way, if we're going to tap into LMI territory, is once we sort of hit 90% and above, the LMI doubles and it increases significantly.
Okay. So that's good news. So 12% deposit.
12% deposit, again, varies lender to lender, but is generally the sweet spot.
Okay, cool. Can I set up my mortgage with an offset that works alongside my business accounts?
In what sense? So you can definitely have your residential loan and that's set up with an offset. With business lending, there's generally no offset accounts linked to any business transaction accounts or business loans.
Okay.
You've got your redraw facility, which is accessible.
Okay. So do most business loans come with a redraw facility or no?
The major banks generally yes. Some of the lower tiers or the second tiers generally would. Some very rarely it wouldn't.
Okay.
It wouldn't. But it's not like an offset account. That's an everyday account.
Yeah. You can't just transfer money.
You can't just transfer.
Yeah. So that's different for businesses and companies, I guess, versus an individual.
Yeah, that's right. With the one thing to note on that redraw facility though, with certain commercial loans and certain lenders, different to your residential redraw, is if you actually hold funds in there because it's a commercial facility. Now, certain lenders are charging a certain percentage if you've got funds in redraw. So, for example, if you've got a $500,000 business loan, you've got $100,000 in redraw, certain lenders might charge you like 0.25%, so long that stays in there. It's not withdrawn every quarter or something.
But it still offsets the other $100,000.
Yeah, of course. It still offsets. And then if there are any actual redraws, they might charge a fee for that too.
Okay. Okay, I think I've got one more question. Given my industry, what fallback options exist if my business hits a tough patch? So maybe you can just talk generally about like if there are any options for people in different industries, if trades or those types of things, just any business that you can think of that hits a rough patch. Are there options that you can work with them on?
There definitely is. So I guess the best thing that you can do as a business owner is plan ahead. And the best thing you can do while you're planning ahead is actually acquire finance when the business is strong and growing. Even though you might not need it at the time, it will allow you to put these buffers in place. And one of the biggest products that I find, speaking to a lot of business owners, particularly tradies, people in that construction space where the funding cycle can take a while by the time you get paid from your suppliers and complete projects, etc., is they're not aware of what a business overdraft actually does.
What does it do?
Business overdraft is essentially a facility, a revolving facility. So there's no end term that's linked to your transaction account, and it acts like a line of credit. So for example, you bank with NAB. You got a business transaction account with NAB.
Yep.
We'll apply for a loan. So the loan assessment is essentially the same because they still deem it as essentially a new product or a new credit facility that they're providing.
So have to go through the process of...
Yeah, you'll have to go through the standard process. But let's just say we apply for a $150,000 business overdraft and we get it approved. That $150,000 is a new line of credit that's linked to your business transaction account.
Right.
And you're only paying interest on that because it's a revolving facility. So it never ends. And you're only paying interest on the amount that you utilize.
So say, for example, I've got a big payment that comes out and it's like, or say I've got to pay wages and it's like 20 grand and I don't have that 20 grand sitting there right there and then.
Yep.
It could come out of that account. It could just go negative rather than positive in the transaction
account. Yeah, that's
account.
right. So let's just say you've got 100 grand sitting in your business transaction account. You've got a huge payment coming that needs to come out. That's 200 grand.
Yeah.
So it'll essentially your account will go from positive 100 to negative 100.
Yep.
And let's just say in 7 days' time, you bring that account back into a positive state.
Yep.
Come month end, you're only going to pay interest on 100 grand because that's all you utilized.
For the 7 days.
For the 7 days.
Yeah, right. And so you got to organize that through your bank to have that ability to go negative.
Yeah, again, yeah, for sure. So that's essentially the business overdraft product. So once you're approved for it, you sign your loan documents, they'll set that up for you. But you definitely need to speak to a commercial broker that can help you set that up or your bank that can help you set that up. And going back to your question around COVID and difficult times and things like that, I was at CBA at the time, but we did have a client that had a business overdraft set up. And that's what essentially saved his business.
Right.
Because business had taken a hit, but he was able to tap into that business overdraft. Yes, his overdraft was in a deficit, but until he could get his business back on track and payments were starting to come through, he was purely relying on that. And then when payments came through, topped it back up to a positive state.
Yeah. Cool.
It's a pretty cool product that not many, business owners know about, but it's definitely worthwhile exploring.
Do you have to be a company to do that, or could you be a sole trader?
I don't see why you couldn't be a sole trader.
Yeah, okay.
It'd be a little bit more difficult. Generally speaking, it is for when you are a business and you're sort of turning over a fair bit, because not that there's any metric or benchmark, but on a very, very high level, the way you should sort of consider it is if you're turning over $1 million, when you're applying for a business overdraft, you should sort of look at about 10% of your turnover. So 100K business overdraft facility.
Oh, right.
Not that that's a metric to follow, but just as a rough guide.
Yeah, right. So 10%. I'm going to include all the actual questions here that you would ask a broker in the links in the show notes and in the video description. So if you are going to see a broker, if you're going into this world as a business owner, having all these questions at the back of your mind is so important. Like a lot of this stuff actually today, just even speaking to you right now, I didn't know existed. So these types of things, like I'm thinking about business overdrafts and stuff. I still rely on Amex business card. Like, it's not the best form of funding because it's expensive, right?
Yep.
But a lot of business owners listening to this and tradies and stuff would have credit cards and things that they just kind of use to help with that, right?
Yeah, of course.
Yeah. When there might be something so much better, just having a conversation. Speaking of which, if people want to get in contact with you, how do they do that?
There's a few ways. Email. We can leave the Calendly link if they want to book directly.
Yeah, sure. I'll put that in the show notes as well. So I'll link to book with you at Solara.
Yeah, that's right. That's probably the best way, to be honest with you. That'll sort of show my calendar and diary.
Yeah, cool. Okay. And that's free and people can just book in, right?
Yeah, of course.
And do you primarily do commercial lending or do you do both?
So given my background, accounting, lending, I do like to specialize in work with self-employed.
Yeah.
Don't get me wrong, definitely still work with PAYG as well.
Yeah. And
to answer your question, yes, commercial and residential lending.
Okay, cool. All right. So if you could leave, my final question for you is, we're just talking about this off here. I actually think debt is a good thing. I actually think debt is a positive tool that you can use. If you're sensible, it will magnify your wealth. 100%. If you're not sensible, you're probably getting strife, which is all the stories that we hear. But if you are sensible, I think it's a huge opportunity, and especially for business owners. So if you could leave all business owners with one tip or trick or something to remember from this conversation today, one thing that you would remind them or prompt them, one thing that you get them to do right now after they're done listening to this episode, what would it be?
One thing that I always tell my clients is pre-planning. I think it's so important.
Right.
And what I mean by that is if you know you are going to or you want to borrow within the next 12 to 18 months, then pre-plan and speak with your accountant and broker, because essentially they're part of your team. Particularly if you're a business owner, you need to have the right people in your corner, right? And why I say speak with them is because that's where you can work out how you're going to prepare your tax returns and financials for the next 12 to 18 months.
Right.
There's two ways to look at it. Your accountant can either prepare them on a tax minimization level or a wealth creation level, right?
So they could adjust the accounts in a way that's still legit.
Yeah, everything is legit, but I'm saying certain things can be pushed back or whatever they do. They're the experts in it. So
you look like you've got more or less profit.
Yeah, that's right. And at the end of the day, you are going to structure it in a wealth creation way if you want to borrow in the next 12 to 18 months. So yes, you're going to pay 10, 20K more tax, but that might allow you to borrow $300,000 to $400,000 more.
Yeah.
And then the year after, when you know you've achieved your loans and taken out what you need to take, your accountant's going to obviously prepare them at a tax minimization level again, where you're paying less tax.
It's such an important reminder. And throughout this conversation, I was constantly thinking of all the trades, sorry to pick on the trades, that still do a lot of cash jobs. And then they try and go get a home loan or a business loan to buy a warehouse or equipment. I'm like, it's not going to happen. Because if you get all this cash, yeah, sure, you don't pay tax, but no one's going to give you a loan.
Correct.
So I think that most people that are in those types of industries where you might be a contractor receiving cash, yeah, I think that it's actually really short term. Like, it's really myopic focus. But if you actually think about it, you want to show big profits so you can get bigger loans and invest, in bigger assets. Really, really important. But mate, Ange from Solara, really, really appreciate your time. It's great to chat today.
Thanks, Owen. It was a pleasure being on.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.